Let's dive deeper into the even and odd strategy for trading on volatility indices, such as Volatility 75, 100, and Jump Index. The goal here is to predict whether the last digit of a financial asset's price will be even or odd based on market trends and technical analysis. To do this effectively, candlestick patterns, market momentum, like MACD, and the statistics of digit occurrences play crucial roles. Here's how it works step by step. 1. Understanding the basics of even and odd prediction. Even digits. Any number that ends in 0, 2, 4, 6, 8 is considered even. Odd digits. Any number that ends in 1, 3, 5, 7, 9 is considered odd. The task is to predict whether the price will end with an even or odd digit based on the market's trend. Uptrend, odd prediction. When the price is rising, the theory suggests it's more likely to end with an odd number. Downtrend, even prediction. When the price is falling, it's more likely to end with an even number. However, this is not purely random guessing. By applying candlestick analysis, technical indicators like MACD, and derived statistical tools, you can make an educated prediction. Candlestick analysis for even-odd predictions. Candlestick charts show the price's movement in a given time frame, e.g., 1 minute, 5 minutes, etc. Each candlestick has 4 main data points: open, close, high, and low. Candlesticks help identify patterns such as trends, reversals, and continuations. Uptrend candlestick pattern, bullish. If you see a series of green candlesticks, it indicates a rise in price or an uptrend. In this case, the probability increases that the last digit will be odd. Downtrend candlestick pattern, bearish. If red candlesticks dominate, it suggests a price drop or a downtrend. Here, it's more likely that the last digit will be even. Key points. Short-term trends, within 5 to 10 candles, are the most reliable for even-odd predictions. The strategy advises not staying too long in the market, max 10 runs, due to the volatile nature of the price movements, which can reverse suddenly. 3. Using MACD as a momentum indicator. The MACD, Moving Average Convergence Divergence, is a technical analysis tool that measures the strength and direction of a market's momentum. It consists of 2 lines: MACD line, difference between 2 moving averages; signal line, a smoother moving average of the MACD line. Additionally, the MACD produces a histogram which shows the difference between the MACD line and signal line. Here's how MACD works for the even-odd strategy. MACD positive. When the MACD histogram is positive above the 0 line, it indicates bullish momentum. The market is moving up. This is when you should focus on odd-digit predictions. MACD negative. When the MACD histogram is negative below the 0 line, it indicates bearish momentum. The market is going down. This is when you should predict even digits. Why use MACD? The MACD gives you an idea of the market's momentum and helps confirm the direction of the trend. By using this indicator, you reduce the randomness in predicting even or odd digits. If MACD shows strong momentum, it adds confidence to the candlestick analysis. 4. Incorporating over-under predictions with derived analysis tool. The derived analysis tool allows you to track the frequency of specific digits appearing at the end of price ticks. This is critical when trading over-under contracts because it helps you statistically assess the likelihood of a digit appearing. Over contracts. Predicting that the last digit will be 4 or higher. For example, if you're trading an over 4-3 contract, the goal is to predict that the last digit of the price will be 4 or higher. Here's how you use the derived analysis tool. Even digit occurrence. If you see that even digits, especially 8, are appearing with a frequency of 12% or higher, it's a strong signal that the market will likely end with a higher digit. At this point, you would place an over 4-3 contract. Under contracts, predicting that the last digit will be 3 or lower. For under 765 contracts, the derived analysis tool helps identify when certain odd digits, like 1, show up more frequently. Odd digit occurrence. If the number 1 appears at a frequency of 12% or higher, this indicates that the market is favoring lower numbers. This is a signal to place an under 765 contract. Even contracts. The number 4 is a special case in this strategy because across all volatility indices, volatility 10, 75, 100, 50, if the number 4 shows up with a frequency of 12% or more, you place an even contract type. This is a statistically driven signal to bet on even digits. 5. Why choose jump index, volatility 75, and 100? These indices, jump index, volatility 75, and volatility 100, are known for their sharp yet consistent price movements. They tend to follow trends more reliably compared to some other assets, making them suitable for the even odds strategy. Jump index. This is a smoother index with more stable trends, making it easier to apply candlestick and even odd analysis. Volatility 75 and 100. These indices have higher volatility, which means faster price movements and more opportunities to trade. However, it also means you need to be cautious and not stay in the market for too long, limit to 10 runs. The volatility of these indices gives you frequent price changes, which is key for even odd predictions. The strategy hinges on the fact that markets in strong trends tend to have predictable behaviors in terms of their final digit. 6. Limiting risk and managing uncertainty. One of the golden rules of this strategy is not staying in the market too long. Because price trends can reverse quickly, the idea is to limit your exposure to a maximum of 10 runs. Why 10 runs maximum? Market conditions change rapidly, and the longer you stay, the more exposed you are to trend reversals or random fluctuations in digit outcomes. By capping your trades, you reduce the risk of losing gains from a trend that may suddenly reverse. 7. Summary of the strategy. Trend prediction. Use candlestick charts to identify trends. If the market is in an uptrend, favor odd predictions. If it's in a downtrend, favor even predictions. MACD confirmation. Use the MACD to confirm the momentum of the market. A positive MACD indicates strong upward momentum, favoring odd predictions, while a negative MACD suggests downward momentum, favoring even predictions. Derived analysis for over-under. Use the derived analysis tool to track the frequency of specific digits, like 1 or 8. When these digits show up more than 12% of the time, it provides statistical backing for making over-under contract predictions.